In today's global economy, China is a major player, the largest developing economy. How is China changing the world's economic landscape? Hello, I'm Anand Naidu in Washington, D.C., and this is The Heat. The second largest economy in the world, the biggest developing economy and largest in terms of purchasing power. And despite an economic slowdown, China is still growing at nearly 7% this year. The country's manufacturing-based economy is focusing on innovation to usher in the next phase of its growth. To tell us more about China's economy and its future, CCTV's Martina Fuchs joins us now from Beijing. And Martina, where does China stand in the global economy today, and what is the outlook for 2017?
Anand, as we near the end of 2016, China's economy is looking pretty good. Earlier this month, Chinese Premier Li Keqiang reassured the world that China will maintain steady growth and speed up its economic transformation. Data from the end of September indicated the world's second largest economy has stabilized and is still on target for 6.7% growth this year. This was mainly thanks to increased government spending and the mini property boom. So what are the main hurdles ahead? China is in the process of trying to rebalance its economy to adapt to slower growth, both at home and abroad. At the same time, policymakers are also wrestling with a wide range of domestic issues that could be disruptive, mainly prices and rising debt levels. Despite the slowdown, China continues to serve, though, as a stabilizer for the global economy. It remains the single largest contributor to world GDP growth. China is also taking steps to create sustainable economic growth with the Asian Infrastructure Investment Bank, the AIIB, which was launched last January, and the One Belt, One Road initiative. Like the ancient Silk Road, One Belt, One Road will create overland and maritime trade routes connecting China and the West. China's yuan, though, has also joined one of the world's most exclusive clubs for global currencies. This is important to say. The International Monetary Fund has added the yuan to a special basket of currencies that countries can receive as part of IMF loans.
Now, China is undergoing an economic slowdown. What kind of impact is that having?
Definitely. Based on the data from China released in October, the economy is on a much more stable footing now than at the start of the year. Data released over the past couple of weeks indicated continued stability but slower growth. Economic indicators ranging from exports to bank lending, along with expectations of a cooling in the red-hot property market, all suggest growth might flatten out in the coming months. There are also mounting fears of potential trade friction with the US when President-elect Donald Trump takes office in January. That's clouding the outlook a little bit. Top policymakers and investors are also growing more and more concerned about the risks of a debt-fueled stimulus. China's overall debt has jumped to more than 250% of GDP from 150% at the end of 2006. This is the type of surge that in other countries has resulted in a sharp economic downturn, as you know. Foreign governments have been urging China to take more measures to curb overcapacity in smokestack industries like steel or coal. China is doing that and much more. President Xi Jinping said he committed to supply-side transformation and really strengthening innovation. Back to you, Anand.
Thanks, Martina. That's CCTV's Martina Fuchs reporting from Beijing. Joining us now from Beijing, Zhou Hao is a professor and associate dean of the School of Finance at Tsinghua University. From New York, Ezra Prasad is a professor of economics at Cornell University and author of Gaining Currency, The Rise of the Renminbi. And with me in the studio, Yukon Huang is a senior associate in the Asia program at the Carnegie Endowment for International Peace. Thanks to all of you for joining us. Zhou Hao, let me start with you. China's economy is experiencing something of a slowdown right now, but it is on track to meet the government's target of 6.5 to 7% for this year. What do you make of that growth rate, and is it enough, in your view, to lay the foundation for sustained growth over the next few years?
Okay, there are clear signs that the economy is rebounding. We can see that the PPI are increasing from -6% to positive recently, and also there are other recovering, coal price, copper price, steel price, and also you have seen recently rising housing prices almost create a bubble. So all these signs putting together, there seem to be the economy has bottoming out. However, it still remains some dangerous area that could pose dangers to the economy. For example, one is a housing bubble, which has been under control recently. The other is exports. Exports is decreasing with the global trade. And the third thing is the private investment. In the contrary to the fiscal stimulus enacted by the government, the investment of the private enterprise is still dwindling. I think those areas are still worrisome and need to be watchful.
Shuo, from 2008 to 2014, China contributed something like 30% to world economic growth. Looking at the growth rate right now, what kind of impact will the current slowdown have on the world's economy?
Now, certainly China's growth does seem to have stabilized, as your previous guest pointed out. The good thing is that in China, domestic demand is doing quite well. The industrial sector does seem to have stabilized. The services sector is doing all right. Investment overall has done quite well during this upturn, even though private investment, again, as your previous guest mentioned, does not seem to be doing quite well. So the big question for the world economy is whether China is going to be able to maintain this growth rate in the range of 6.5% to 7% without a significant contribution from exports. Because the reality is that the rest of the world simply isn't in position, except perhaps the United States, which is growing all right. The rest of the world cannot really absorb much Chinese exports. So domestic demand is the key issue. The problem is that if domestic demand comes largely from investment rather than from consumption, that could increase the dependence of China on exports in the future, even if it sets it off in the short run. But overall, the portents in the Chinese economy in terms of its rebalancing towards an economy that is more dependent on service sector growth, that is more dependent on consumption growth, those are all very positive signs. The big concern really is still about the midterm, the medium term, whether the risks being created in the system still with financial system imbalances continuing to rise, whether that's going to cause a problem for China and the world beyond the next couple of years.
Yukon Huang, what is your view? How does China adapt, retool, in order to make this rebound very real?
Well, as the previous guests have indicated, you cannot count on global demand, so you have to count on domestic demand. Essentially talking about whether it's going to be consumption and investment. In some ways, whether it's consumption and investment is not the choice or the issue. The question is which one makes sense and what does the economy really need at this moment in time. There are things the government is addressing that could help. For example, they have a new urbanization initiative. This is a country which is still only 56% urban. People projected to become about 65% over the next decade, which means that people are going to be moving to the cities. That means you're going to have to build more housing, more social services. That's a big concern. This is a country which is becoming more services-oriented. A whole bunch of activities, investments, expenditures could be supportive of that. You have this big issue about the productivity of state enterprises and private enterprises. Private investment has been down, as the previous speakers have indicated. But can you liberalize investment in various protected areas so that there is, in fact, greater encouragement for private sector activity? If you do some of these things, then you can get the demand going. And demand may be consumption, demand may be investment, but surely China needs to do something to make this more sustainable.
Zhao Hao, you mentioned some of the weaknesses that China is experiencing right now, the housing bubble, exports, as well as private investment. We talked about exports. What about the two other factors you mentioned, the housing bubble and private investment?
Okay, so the housing bubble has been mostly driven by the monetary policy. In the last few years, when the economy slowed down, the initial choice by the government is using the monetary policy, which is easy, quick, and reflected in the stock market bubble last year and housing bubble this year. However, the monetary policy can only, cure the symptom, but cannot cure the cause of the slow economy. So going forward, what we would expect is that the main stimulus will be shifting from the monetary to the fiscal policy. So if you remember, since last October, we haven't seen the central bank lowering the reserve requirement or the interest rate. But going forward, we know the government has enacted a huge stimulus package, including high-speed rail, infrastructure, and other urbanization projects nationally. So I think in the next 2 years, we will see more structural fiscal stimulus, but not too much monetary policy stimulus. And that would, form the basis we could judge that in the next few years, the economy probably will grow a little bit higher than the 6-7% we have observed this year.
Ezra, dozens of cities in China have taken steps to cool the property market, some requiring higher down payments. Some economists have warned, some businessmen have warned in China that it is spiraling out of control. What are the risks of a property bubble bursting?
I think the property price bubble and the private investment or lack of private investment issue that you mentioned come back to one fundamental problem that still bedevils the Chinese economy, which is that the financial system is not working very well. It's not working very well in terms of allocating the massive pool of domestic savings that there is in China into more productive investment opportunities. And what happens as a consequence is that you have financial system imbalances building up in one way or the other. Remember, just about 2 years ago, the big concern was about house prices falling too fast, and then stock prices rose too fast, and then fell too fast, and then there were concerns about the currency, the renminbi. And now we are back to housing prices rising too fast again. So the reality is that unless you fix the financial system and get it working better, which is going to involve fixing the incentives in the banking system, trying to get the banks to start behaving more like commercial enterprises, it's going to be very difficult to prevent these financial imbalances from coming up. And it certainly makes growth a lot more vulnerable if it's being boosted by these financial imbalances that pop up and then subside. If you want what Professor Huang mentioned, that is more productive opportunities in China being exploited well, productivity to be increased in the services sector and so on, you need to have more finance going to small and medium enterprises, to the services sector, and that's not happening. So fixing finance, I think, is crucial for dealing with these financial sector imbalances and also to make China's growth more sustainable.
Yukon Huang, as Ezra points out, there's a huge pool of private savings. Why isn't that used in a better way?
Well, China is a very unusual situation. In the midst of a slowdown, incomes have stayed relatively high. There's an enormous pool of savings. It's sloshing around. It goes to the equity market. It goes into housing. It goes overseas. It'll go everywhere where it sees opportunities. Part of the reason that the housing market surged over the last year was that the government actually was discouraging funds from moving overseas, and therefore was looking for what to do domestically. And since the stock market is in the doldrums, they went into housing. So the question is, you have to increase the alternatives for these savers. So the equity market, for example, needs to be made more attractive. It needs to be made more representative of the whole productive structure of China so that people can buy stocks and more money can go in that area. Over time, China needs to liberalize its capital outflows. It's reasonable, in fact, that firms and people start investing more overseas, and they have been. But if you stop that flow, you also then encourage people to look for speculative activities domestically. So you have to have a system which is more open, more liberal, but you have to give consumers alternatives. Right now, they don't have all those alternatives.
Now, here's something that needs explaining. As you point out, as Ezra's pointed out, there's this huge pool of savings, but household debt is also rising.
Household debt has increased because a lot of it has been going into mortgages. Some of it actually is financing informal industrial activity, hidden as household debt. So household debt is maybe 40% of GDP. Now, it's increased dramatically, but it's not significantly larger than what's normal for other countries. Much of that mortgage financing is reflected in terms of very large down payments, so you don't see a risk. The issues in China tends to be corporate debt, which is 150% of GDP. Government debt's around 60% of GDP. So the real risks lie in the corporate sector. Where are they putting this money? Is it generating adequate return? The fact that mortgage and household debt has surged very recently, partly because the housing market is not so much of a concern given the nature of that mortgage financing in China.
Okay, we're going to have to take a break right now. Coming up, how does the addition of the Chinese currency, the renminbi, in the IMF's special drawing rights basket change China's status in the global marketplace? Stay with us, you're watching The Heat. Welcome back. We're talking about China's place in the global economy. Still with us, Zhou Hao is with Tsinghua University School of Finance. Ezra Prasad is author of Gaining Currency, The Rise of the Renminbi. And Yukon Huang is with the Asia Program at the Carnegie Endowment for International Peace. Let's get back to the panel. And Ezra, let me start with you. As I mentioned before we took that break, China's currency, the yuan, has been added to the special drawing rights currencies by the IMF. It's now the third largest currency after the US dollar and the euro. What is the significance of that?
It's symbolically very important for China and indeed for the world, because it's the first time an emerging markets currency has been officially declared as one of the elite reserve currencies. But ultimately, it's not what the IMF says or what the Chinese government says that matters. It's what markets think. And the reality is that markets, by which I mean both official foreign investors like central banks, but also private investors, what they need are high-quality renminbi-denominated financial assets that they can easily trade in and out of. Right now, China does not have very well-developed financial markets, especially fixed-income markets for corporate and government bonds. China does not have a fully open capital account, although it is moving in that direction. And China does not have a market-determined exchange rate. So it's only with these things in place that the currency will really become a major reserve currency. But still, China is well on the path. It's already become a significant international currency, meaning that it is quite widely used in trade and finance transactions. About a third of China's trade is already settled in RMB. So in that dimension, the RMB is making progress. And I have no doubt that as China continues with economic reforms, which I certainly hope it does, the renminbi is going to become a significant reserve currency, perhaps even rivaling some of the existing reserve currencies like the Japanese yen or the pound sterling. But is it going to become a safe haven currency, one that investors turn to for trust rather than just for diversification and yield? That's going to take a lot more than economic reforms. What engenders a trust of foreign investors is a broad set of institutions like an open and transparent system of government, the rule of law, as well as a trusted and independent central bank. In all those dimensions, progress has been much more limited. So I think the RMB is going to become a very important international currency. If China plays its cards right, it's going to become a significant reserve currency, but I don't see it becoming a safe haven currency that in any way rivals the dollar.
Zhou Hao, one other issue about the Chinese currency, and that is we've heard allegations, these accusations mainly from the United States, we heard it during the election campaign as well, that the country manipulates its currency, that it's buying the currency of other countries. Does China need to do that? Does it do that?
Okay, so suppose we are all believing the free market. So then we would argue that for China, it's better to float the currency. However, in the past, United States government and perhaps some from Congress or during this election, we hear this voice that you should let the exchange rate to be governed by the market forces, but you can only appreciate, not depreciate. This is like saying that you can have the cake and eat it. It's not possible. It's illogical. So we will say that joining SDR is an important step for China to reform its currency, to open capital account. However, whether the currency will appreciate or depreciate will depend on the market, will depend how the Chinese economy is doing, how the US economy is doing, and how Federal Reserve is going to change its interest rate. So we would expect that going forward, the exchange rate will be more and more determined by the market force. However, whether it's appreciating and depreciating, we have to judge it from a fundamental economic performance. That's my view.
Yukon Huang, I want to turn to something else. Now, this is a broader question. The economic model that China follows is sometimes referred to as state capitalism. Is that an apt description, and do you think it's a model that could be used in other developing countries?
Well, you have to look at where China came from. 30 years ago, this is a totally what I call centrally planned socialist economy. It's moved over the last 3 decades into what I call a more market-determined economic system. The bulk of economic activity comes from the private sector. Most industrial production comes from private enterprises. Housing property market is largely private. It used to be all state-owned. Agriculture is largely private. It used to be done by state farms and cooperatives. So it clearly is an economy which is much more market-oriented. But it also has a lot of what I call state-controlled elements. The major banks tend to be either state-owned or state-controlled. A lot of the major resources are in the state's hand. The right to operate in many activities is basically a decision by the government. It's truly a mixed economy. In that sense, it's quite unique. So I see it as a form of state-managed or state-encouraged capitalist model. It's unique by itself.
Zhou Hao, what is your outlook for 2017, given the fact that there is a new incoming administration here in Washington, one that has warned that it might be imposing punitive tariffs on Chinese imports?
I think the Trump team already said that they are not necessarily going to impose a 45% tariff unless the RMB is depreciating 45%. It is equivalent as saying we are not going to impose a tariff. But however, I think given what happens in the designing of Trump's economic policy, which is mostly will be relying fiscal stimulus and infrastructure expenditure, you already see the U.S. Treasury market, the interest rate of 10-year yield already have risen in the last day about 30%. That's indicating that the U.S. economy may grow faster and the U.S. inflation may go faster. So if that's the case, actually you cannot be so sure that RMB will be depreciating precipitously, because if the inflation, U.S. inflation rising faster, then there's a cases made that actually RMB may be stable given that situation.
Yes, well, what is your outlook for the future?
So there is a great irony in Mr. Trump arguing that China is manipulating its currency, and is making this charge at a time when for the last year and a half or so, China has been losing foreign exchange reserves as it tries to prevent its currency from depreciating so quickly. So if anything, China is doing the US a favor by not letting market forces rule and drive the yuan down. But I think there is a risk in the coming months. Mr. Trump has made the creation of jobs and the notion of bringing back manufacturing jobs a big part of his election platform. Now, many of the things he would like to do, improve infrastructure, improve the productivity of the US economy, these are things that are in the right direction but are going to take a long time. So there is a risk that in order to make an easy win in the short run and play to his political base, he could attempt to get tough on China. And that would almost certainly invite very strident and aggressive reactions from China, so it could easily spiral into a tit-for-tat battle. My hope and my sense is that prevail. And so long as the US economy continues to recover and so long as it continues generating good job growth, I think the risk is mitigated somewhat. But if the US economy does start stumbling, there is a risk that you could have a trade war, which is not going to be good for China or the US in the short run. Although in the long run, it might in fact help China, because if the US starts disengaging from the rest of the world and stops leading in free trade, China is ready to fill in the void. So a trade war, if it does come about, I think it's not good for either country in the short run, but could potentially benefit China's influence in the long run.
Yukon Huang, what is your view? Could China in some way for the future spend its way out of the slowdown?
If you spend the way, it has to be sustainable. So you have a cyclical effect that the global economy is depressed. That means you can use monetary and fiscal policy to try to get a little bit more demand than normal. But in the long run, it's basically productivity. And productivity means China needs to move to a growth process which is more productive than it has been in the past, less dependent upon debt, less dependent upon investments, more relying upon what's happening domestically. Those are things that were in the policy framework paper that the new leadership came into being, if they can act on some of these issues. And I think one of the points that I think the previous authors are referring to here is you do need a more open economic regime externally. Trade is under pressure, so working on trying to keep that open is a very important thing. Foreign investment is a very important thing. So the bilateral investment treaty discussions between the U.S. and China, I think is going to become a little bit more important in the coming years, particularly since there's such negative feelings about trade aspects. But you can deal a lot with actually some of the economic issues through discussing a more liberal international investment framework.
Okay, we're going to have to leave it there. Thanks to all of you for joining us. That's all we have time for, but the conversation continues online. Chat with us about this or any other show on Twitter. We're at CCTV_America. We also use Facebook. Find us at facebook.com/CCTV America. I'm Arnold Naidu in Washington, D.C. Thanks for being with us.